The market just flashed a signal we haven't seen since the weeks before Volmageddon in 2018. Sentiment is maxed out, cash is gone, and Japan just put the pin on the global carry trade. I'm looking at a market structure that is mathematically fragile. The narrative on CNBC is no unwinding. The consensus is that AI capex and corporate efficiency have eliminated the business cycle. But as a trader, I don't trade narratives, I trade positioning. And the positioning is screaming danger. According to the latest Bank of America Fund Manager survey, the bull and bear indicator has surged to 9.4. This is the hyper bull territory. We are approaching the highest readings on record historically. When this metric crosses 8, it is a contrarian sell signal. But here is the problem. Cash levels in these portfolios have collapsed to 3.2%, the lowest level in history. Connect the dots. Investors are euphoric and they are fully invested. There is no dry powder left on the sidelines to buy a dip. If a shock hits, managers cannot buy, they must sell what they own to raise cash. This is how a 5% correction becomes a 15% liquidity cascade. So what triggers the selling? It isn't Nvidia, it's Japan. I'm watching the Japanese government bond market. The 10-year JGB yield has broken 2.22. This is the highest level since 1999. Why does this matter for your S&P 500 portfolio? Because for 20 years, Japan was the global anchor. Investors borrowed yen at 0% to buy US Treasuries and tech stocks. That is the carry trade. That trade is dying with Japanese yields at 2.2% and the 40-year yield breaking 4%. Japanese institutions who hold over $1 trillion in US debt are repatriating capital. They're selling US assets to buy domestic yield. This is effectively a global margin call. If Japan stops buying US Treasuries, US yields must rise to attract new buyers, right? Higher US yields compress PE multiples. It is mathematical relationship that algorithms will front-run. Before we break down the domestic liquidity cliff, if you value this level of data-driven macro analysis that you won't find on mainstream media, make sure you're subscribed. We are tracking these liquidity flows daily and you don't want to miss our next video. This brings us to the breaking point. The Japanese bond market cannot sustain yields at these levels without risking a sovereign debt crisis. The thesis suggests that as the pain maximizes, the Bank of Japan may be forced to capitulate and reinstate yield curve control to stop the bleeding. Alternatively, if the yen crashes too hard, the Federal Reserve may be forced to open liquidity swap lines, effectively flooding Japan with dollars to stabilize the system. Either outcome is ultimately a liquidity injection, which is bullish long-term. However, history shows that central banks only panic and print after something breaks. The market usually crashes before the ambulance arrives, not after. We are currently in the phase where the breakage is happening. Now, critics will say the Fed is already printing, and technically they're right. As of December 2025, the Fed ended QT and started reserve management purchases, buying $40 billion a month in Treasury bills. The balance sheet is expanding again, but here is the trap: it is not enough. We are seeing the law of diminishing marginal utility play out in real time. In 2019, it took Fed billions to fix the repo market. In 2020, it took trillions. Today, because the system is so leveraged, it requires exponential liquidity just to maintain linear growth. The Fed's $40 billion a month is merely treading water. We have reached depth saturation where new liquidity is instantly absorbed by debt servicing rather than fueling asset prices. The Fed is pushing on a string, and unless they drastically increase the dose, the withdrawal symptoms will hit. Now the bull case is strong. The data shows S&P 500 revenue per employee is at new highs. Productivity is booming. Corporations are leaner and more profitable than ever. This explains the margin resilience, but the corporation's efficiency is a workers' unemployment. We are seeing a fracture in the economy. Corporations are rich, consumers are insolvent, credit card debt just hit a record $1.22 trillion. More alarmingly, 61% of debtors have held balances for over a year. Delinquencies are surging. The unwinding narrative assumes the consumers keep spending, right? But if the consumer is funding spending with debt and banks tighten lending standards as liquidity drops, consumption stops. So how do we play this? Well, let's look at the calendar. Seasonality data going back 20 years shows that February is often flat, but the window following February OPEX into mid-March is notorious for volatility. The date I am watching is March 1st to March 12th. History suggests markets push into this window before finding a wall. The strategy is patience. With sentiment at 9.4 and cash at 3.2%, the upside is capped and the downside is unprotected. I'm looking to deploy cash only after we see the liquidity flush from Japan's repricing and the seasonal low in March. Until then, cash is the position. I want to know your take. Are you buying the unwinding narrative or are you raising cash like me? Let me know in the comments below, and if you want the update when the liquidity signal officially flips, hit subscribe. I'll see you in the markets.